Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments, surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
Good afternoon. It's Saturday afternoon, and we are talking about money. And what we're going to talk about today is we're going to break down what's going on in the economy.
Yeah.
Why is the consumer so resilient? What's going on with that? I mean, typically what's happened in the past, the Fed starts raising interest rates. There's a lag. We know it doesn't happen instantaneously, but certainly within 9 to 10 months, people start to feel it and slow things down, and consumer spending starts to contract. Businesses pull back. We are seeing businesses pull back. We've seen some layoffs, though we don't really believe the layoffs are necessarily attributed to a slowing economy. But what's going on in the marketplace? Why isn't the consumer pulling back? Why do they feel free to just keep on spending money? And why is it that the people that are supposed to know, the prognosticators, the so-called experts, have all gotten it wrong?
They have gotten it wrong. I mean, beginning in early 2022, when the Fed began to raise interest rates, Goldman Sachs came out and said, we're going to have a recession before the end of the year. JP Morgan came out and predicted a recession. When they did surveys of business leaders thought we were going to have a recession. Everybody was convinced by the end of 2022, that was last year, we would be in a full-blown recession.
But what happened? Why haven't we seen anything yet?
Well, they began to think that maybe the recession is going to be in early 2023. Or late 2023.
I don't think we're going to see that this year.
I don't either.
And there's some interesting data that, we talk about, you and I talk about this all the time, right?
Yes,
a couple times a week that we're like, hey, what's going on here? What's happening? And we always come up with the idea of, we say, what's happened has never happened before, right?
Yep.
And we're in one of those right now.
We are.
And I want to read you this article. If you get a chance to read it, go back and read Megan Carcella's article from Barron's about the Fed and everyone else got the economy wrong. It's a really good article and break down some numbers that why things, and why they didn't see it is kind of funny because it was right there. It was right in front of their face.
But what's also right in front of their face is every time we did this in the past, not only in the United States, but in other countries as well, it worked.
Yeah.
It always worked, So why wouldn't it work this time?
Well, one of the things they say here, is that, I'm trying to find my place here, dozens of top academics and Wall Street economists is that the host of factors played a role in forecasting and initially might have underestimated or overlooked a part because they had never collided this way before.
Actually, yeah.
And what we're talking about, I think, and what they failed to factor in is we've had close to 14 years of almost 0 to 1% interest rate.
Correct.
Now, typically what's happened in the past is that 60% of mortgages were variable rate mortgages. Since recently, because things were so inexpensive, money was so inexpensive, people locked in rates that were way below historical level and locked in fixed payment.
At 2.5.
At 2.5, 2.9. I think when I locked mine in, it was 2.9 or 2.89%.
Yeah.
Historically, that's really low.
Historically, it should be around 5.
And that's so that number went from 60% of variable rates, Mike, to 10%.
Yeah.
And that happened with a lot of school loans. That happened with a lot of credit cards. People refinancing, locking that debt back up and taking that money off the table. Now that's a fixed payment as opposed to, oh, wait, now what's going to happen with my mortgage next month if interest rates go up? Those are off. That's gone for a lot of people.
And for a lot of people, it also meant that as part of their disposable income, it was a lower percentage.
Exactly.
So instead of being, typically when somebody buys a new home, you look at around 30% of their net income. Mm-hmm. Instead of being 30%, it's down to 20% for a lot of people. That means 10% of their disposable income is available to spend, and they spend it.
And when you throw on top of that what's happening in the unemployment in the job market, now you're doubling down on that because now that guy or that person is saying, hey, I can go get another job that's going to pay me 6 or 7 or 8% more.
Yep. And 47 million Americans quit their jobs last year.
Yeah.
A part of that was they didn't want to, those people that were forced back to the office, they got new jobs. But a good portion of those people were people that were looking for higher paying jobs.
Mm-hmm, mm-hmm.
And when you see a resume as an employer, employer and a person has had a job for 3 months and then 4 months and then 6 months and then 3 months, that raises all sorts of questions. But the people that are job hopping like that, they don't really care.
No.
They're increasing their income each time by 5 or 6 or 7%. And so they'll stay with that one job finally that pays the highest rate if they have to do that. On the other hand, if they can jump the job and get another job 5% higher, they will.
Yeah, and then you put on top of that the $5 trillion that was spent on COVID relief. There was some overspending there. That's still going on. It's still some of that is still trickling out. And consumers are still flush with cash. From what I read, they still have about 10 months of cash to spend.
Yep. And, in 2022, they were buying cars and washing machines and couches and big ticket items. But you can only buy so many cars for most people. And then you want to buy something else. And so what we're seeing is a shift in the spending from big ticket items to, I haven't been to Disneyland. I haven't taken a cruise. Let's go out to eat this tonight and tomorrow night and the night after that and the night after that and the night after that.
Yeah. It says in this article that I think it's another 60% number, but 60% of spending is on services. Restaurant, like you just said, restaurant, travel, and people being pent up after COVID. The psychological factor is, hey, I don't care. I'm going to go.
Yeah.
We know that's probably a lot of that's going on because we see credit card debt starting to increase. We know that people that have been pent up they're going to go.
And even though credit card debt is building up, a lot of that's being paid off every month. We haven't started to see the trickle.
I got some data that shows that's actually
It's starting.
Yeah, to lose some steam that the people are carrying the balances more and more.
Yeah, but it's not reached a normal level yet. It will reach a normal level before the end of the year.
Yeah, it's reaching there, and the other problem is people don't know what interest rate they're paying, and so they realize they're starting to pay 20 to 26% interest where it was 15 before.
Yeah.
So that's another few bucks going out in interest payment.
Yeah, we need the Consumer Protection Agency to gear up again.
I was just consulting with a client, and I suggested that, hey, let's take care of these credit cards because I said these rates are going to get way high and they're going to keep going up for a while. I said this is going to put more money in your pocket. So.
Oh, yeah. When you look at credit card debt, even at 15 or 18%, that's tax-free money. Because if you're paying a tax on the money you're earning to pay the interest on the credit card. So essentially, by paying off your credit cards, you're getting a 15 to 20 to 26% return
on your money.
Yeah.
Yeah. And I tell people that, just at 12%, if you have 10,000 in credit cards and you're paying the minimum payment, that if you divide that into 72, the credit card balance will double every 6 years.
Yeah.
So, but back to the economy, what's going on? Like we saw last week, we saw Walmart come out and say that, they see numbers starting to trickle down. They don't think their profits are going to be as good because people aren't shopping but as we just said, people moved away from that. Then have bought everything they're going to buy. They're still going to buy their staples, but they're out traveling and they're going to keep eating out and doing those things.
And Target had the same kind of thing. They said that the things that they brought in for inventory, the big things, didn't sell at Christmas time.
Yeah, they had a huge overstock of inventory.
That's something that has been running. It's, things that have never happened before happen all the time. And we've been living in a time when that's really been really true. And the fact is, by the time everybody adjusts to all this, we'll be back to a normal kind of the high Fed rates will suddenly end up, and we probably will push into a recession.
Yeah, but I don't think that's going to happen until maybe mid-2024.
Or 25.
Yeah, it might not be too fun for the current administration to have to deal with, but it's hard to time those.
One of the big issues is the number of jobs that are going unfilled. 4 to 4.5 million more jobs created.
Right, and as we talked about, as COVID spending starts to wane, the Inflation Reduction Act, they're starting to ramp up the projects for that. That's starting to get going. And where they're going to find all the people to do those jobs, and a lot of them are technical jobs, even though they might be manual, there's a lot of, because of what they're trying to do with electrification and build out the economy, they want to build, just in Seattle alone, they want to build 7,500 electric charging ports.
Yeah.
Those aren't jobs that you can just pick anybody off the street to do. They got to be trained and know what they're doing to do that type of job.
But it's creating jobs. It started with the Obama administration coming out of the Great Recession, and then the Trump administration, now the Biden administration.
Yep.
Don't go away. We'll be right back. We got more to talk about this.
About money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So we've been talking about what's going on in the economy. And things that have never happened before happen all the time. We saw that with COVID. We saw it with the Great Recession. When we did the FDIC in the 1930s and guaranteed people 100,000 coverage by FDIC, that really started what was called the Golden Age. The Golden Age when there would never again be a panic, a bank panic. Prior to that, when you would have a bank that ran into financial problems, if it was one bank, they would borrow from other banks to pay off their depositors. But if you had a number of banks which were in trouble and beginning to have financial problems, people would rush to the bank, they would want to withdraw their money, and since they didn't have that much cash on hand, since they had the money loaned out, you would have what was called a bank panic. People wanted their money out of the bank, and the banks didn't have enough to pay them off, and so the banks would close, and you had what was a bank panic. And we had that going on. We had it in the 1800s. We had it in the early 1900s. We had it at the beginning of the Great Depression. Banks closing up and not paying off their depositors. And so the administration came up with the idea of the FDIC, banks putting in a penny on every deposit to guarantee that if there was a run on the banks would be able to take the money out of the Federal Reserve and pay people off. It was easy. It was easy. And for 70 years, there was never an issue. If a bank failed, the Fed would step in, or not the Fed, but the Office of Banking and whatever they're called, they would step in and they would pay off the depositors. And the depositors felt safe. The people felt safe. They knew that their account was guaranteed to $100,000. Only you began to have some institutions and some endowment and some hedge fund and financing companies that had amounts they had $100 million that they had on deposit with banks, not 100,000. And they wanted repos, what were called repos.
He's good.
The
Loves
famous
to,
repos.
Loves to talk about his repos.
And I can remember they were called 7-day 7 because on Tuesday they would come up for auction bid and people would bid on how much they would pay for these collateralized debt obligations. 7-day 7. The interest rate was reset every 7 days. And that became a guarantee for the institutions. So you built a shadow banking system that economists didn't see, federal regulators didn't see. No one saw that there was a shadow banking system that essentially started around 1975 and began to build up. And by 2007, 2008, it was crashing. That had never happened before. Economists said in 2005, 2006, it can't happen because we're living in a golden age and we have FDIC.
But we have collusion with the banks, the Federal Reserve, and everybody knew what was going on. But
I mean, it's one of those things. Economists didn't see it coming.
No.
Business leaders didn't see it coming. Federal regulators didn't see it coming. These things are happening now on a more regular basis. And so we were talking in the first part of the program about how did they get it wrong? The Fed's raising interest rates, and that should result in a recession. It hasn't, not in the least.
But that's what dominates the news cycle, right? Is recession. I mean, who was it that came out this week? Hedge fund manager Leon Kuperman.
Yeah.
The Dow is going to drop 22% from where it is today, or he said 35% from its high of 4,800, which leaves it about the same place at 3,120.
Yeah, almost every day I get an email saying the bottom's going to fall out.
I just wonder where he has holding all his short positions. That's all I think about.
Well, they not only hold short positions, but there's a flight to quality. We talked about that before. Is that they're selling out of their stock to buy bonds. That's why bond rates are so low. I mean, historically, long-term bonds should be higher than what the Fed is. Yeah. And historically, the bonds should be at least 1.5% or 2% over the rate of inflation. So you would expect the long Treasury to be at 6.5% or 7%. Instead, it's under 3% because there's so much demand for those long-term bonds because everybody knows it's without exception. They know, well, with a few exceptions, we're one of the exceptions. Everybody knows that the stock market's going to crash. And so having bonds means you lock in an interest rate and you preserve your capital so that when the market crashes,
you can go buy stuff cheap.
You can go buy stuff cheap. But the reality is we talked previously before about Renshaw and his study.
Mm-hmm.
And Renshaw said 90 days after you hit a market bottom, you'll have recovered a third of what you lost. And we saw that. October 12th, we saw the bottom. And January 12th, we saw that the market itself, measures Standard & Poor's, was up 37%. It recovered 37%, not of the market, but 37% of what was lost. And Renshaw said that afterwards, the market will continue to go up more slowly.
And his study only went to 1990.
Yep.
But we calculated the years after that, and it all held true during a downturn.
It did.
So he had his 100. Was he have? He had like 80 years. 42 years of data.
42 times.
42 times, and then it held true even after.
Held through .com.
Yep.
Held through 2008.
Yep.
Held through the. Actually, there's 4 more times because I'd forgotten about 94. And it held in 2020. So I mean, that's one of the things people were not looking at and have not looked at, and maybe nobody really remembers who he is. I mean, he was pretty obscure.
Well, I mean, and one of the headlines I read this week, I can't remember where I read it, but it was, I think as it said, as January goes, I don't think so, or something like that. Because statistically, right, if the first 5 days are up of January, we have an 83% chance of the market being up that year. And if January's up, it's like another 75% chance of the market being up. And now we have a terrible February. Right? February was a bad month. February is statistically the second worst month of the year.
And actually, if you look at our accounts, they were up in February.
Yeah.
I mean, we're having a really good year. We had a really awful year in 2022.
Well, the guy that we're going to talk about in the last segment and a half here, he's had a couple crappy years too.
He has.
But I got a 65 or 70 year track record, and it's pretty dang good over the time, long term.
That's Warren Buffett, of course.
Yes, we're going to go over some of his newsletter and some of his returns later on.
Yeah.
But so that's just where the market's at right now. And you and I are bullish. We think it's going to keep going, but there's a lot of people that just want to pour water on the market and want to put out any sort of. And then when I read this morning, someone said the Fed's job wants to slow the stock market down. I'm like, I don't think that's not their job.
No.
The stock market shouldn't even figure into what they're trying to do.
Jumping ahead just a bit, and we'll come back to it. But there was one thing that struck me about Buffett's letter.
Yeah.
He said, if you don't see the world the way it is, it's like judging something through a distorted lens.
Yeah.
I think that's so apropos. It's so key to what's going on. And that's why so many people are missing it. They're looking at the world the way it was, not the way it is.
Yeah, exactly. It's like, a quote here from Ray Dalio says that those who live by the crystal ball eat shattered glass. Right? I mean, you're trying to look back. We talked about this, trying to look backward.
And extrapolate
Going forward. I told you about the conversation I had with a client who gets one of our, friends' newsletter, who talks about how he, had some bad times with his algorithm, went back and rebuilt it and retested it from 2000 and 2008 and a couple other time periods, and how well it did. He, made 3,000 or 4,000% or whatever, something like that. But who can say that the market's going to perform the same as those time periods? Just because we have inflation now, and to go back and say, oh, this is like 1968 through 74, there might be some similarities, but it's not even close when you calculate the fact that most people got to refinance their mortgage at a tiny, fraction of what the historical rate was, and locked those rates in for 20 or 30 years. And
got stimulus checks and got jobs that they can move from job to job to job.
Yeah, I don't think there were that many jobs in the back then that were open like that. I think it was much tighter labor market.
Oh, and remember, unemployment reached almost 10%, maybe over 10% during the late 70s.
Yep.
We're at a record low, not a record low, but the lowest unemployment we've been at in over half a century.
Mm-hmm.
It's a remarkable kind of thing. So we want to look at the world the way it is, not the way it was.
Yeah, there's one other guy that we met at one of our shows, Mike, who keeps sending me things. His whole tagline is "Tomorrow's numbers today."
We're coming to a commercial break. Don't go away. We're going to return to this. And we're going to talk later about Warren Buffett and his annual letter, because I think it has great insights into today. Don't go away. We'll be right back. For a number of years since 2016, we've been saying the way the secular bull market would end, in all probability, would not be with another Great Recession, but with inflation. We thought this was going to happen. We felt this was going to happen. And unlike what's going on today, we didn't have the crystal ball either. We thought that it would be like the 60s and 70s. What would have happened in the 60s and 70s is the Fed raised interest rates and unemployment increased and businesses began to slow and shut down. But what we also saw is there's big differences between 1960 and the 1960s and 70s and the 2020. And so you have to adjust and look at the world the way it is, not the way it was. And yet you can't forget about what happened in the 60s and 70s either.
No, but we talked about this in a previous show. We were much more manufacturing focused. Interest rates hammer manufacturing companies. We had, I think it was 30% of the country was unionized. It's 10% today. Those are two big factors that aren't really, when you want to make the comparison, that you can't really, are not even close.
Mm-hmm. And while we had interest rates that were rising and home prices where people had a lot of fixed rate mortgages, they were higher than they were. And so it wasn't like today where, as you mentioned earlier, so many people have fixed rate mortgages which are very, very low.
Really? Yeah.
We didn't have stimulus checks that went to people. So many things are different this time. But I think we also have to think about we're living in a very special time right now, but the special time may evaporate too. Not this year, probably not next year, but when you look out toward 2025 and 26, it could have a significant impact on what's going on. So don't forget the past. Understand that, as Mark Twain said, history doesn't repeat, but it rhymes.
I think one thing that's coming up, though, we talked about the debt ceiling. I don't think back in those times we had the debt that we have today.
That's correct.
And that's a big matzo ball hanging out there that has to be reckoned with at some point. And I think Warren Buffett mentions in his letter, if you read the end of it, talking about that hey, he breaks it down tax-wise. We're taking in X amount, a billion, trillion tax-wise, but we're spending where debt is this trillion over that.
So the question is, the debt was a lot lower then. If you look back in the 50s and 60s, I haven't looked at the numbers.
No, and you're looking at per capita of GDP, right? The percentage of the percent of GDP it represents.
Percent of GDP represented by the debt. And remember, in the 50s, we were coming out of World War II with a very high level of debt.
Mm-hmm.
And because the economy was doing so well, the government was running a surplus rather than a deficit, instead of going through this whole thing of cutting taxes. So if you go back to the time when I was young, John Kennedy, JFK, came up with the idea of cutting taxes because I think the highest tax rate back in the 60s was 90%.
Yep.
90%.
Mm-hmm.
I mean, and so he came up and his economic advisors advised him to cut taxes to stimulate the economy. Now, during Reagan time, when Reagan was president, Art Laffer was an economic advisor,
mm-hmm.
and we ended up with the Laffer curve, which explained why Kennedy's tax cut made sense.
Mm-hmm.
Because the Laffer curve, of course, is that upside down U.
Mm-hmm.
And on one side, if you don't charge any taxes, the government brings in no income. If you charge 100% taxes, nobody works because if all the money goes to the government. So 100% taxes, the government brings in no money either because nobody works.
Mm-hmm.
So it depends upon where you're on that curve. And if you're on the left side of the curve, by raising taxes, you bring in more money into the government. On the right side of the curve, if you raise taxes, you bring in less money. And the converse goes for cutting taxes. And I can remember reading that Kennedy wanted to cut taxes by an average of just $100 per person. And I can remember at that time, that was when I was in college and studying economics, and the economists were saying, what will $100 per person do? It's so small. If you really want to cut taxes, you need to make a significant cut. But that $100 tax cut per person, per capita, had a significant impact on goosing the economy. So given that, administrations one after another has thought about cutting taxes to stimulate the economy and bring more money into the government. And perhaps there's no better example than the Bush tax cuts, which simply reduced the amount of money coming into the government without stimulating the economy.
Mm-hmm.
Or the Trump tax cut that didn't stimulate at all.
Mm-hmm.
And if you look at what Jindal did in Louisiana, cutting taxes, it almost led to Louisiana going bankrupt. I mean, so it's understanding where you are and understanding what's going on and looking at how the world is and not about how the world was.
Well, we had our last surplus was when Clinton left off, and then of course it's evaporated since then.
And of course, remember,
And
he raised taxes.
he did, and then it goes back to what Keynes said, right? Keynesian economics was okay. In good times, you're supposed to save the money. In bad times, the government spends money to dig us out of a hole, keep the economy afloat.
Mm-hmm.
But in good times, even when we have good times now, we're not balancing the budget and we're not saving money.
We're not reducing, and we're not running a surplus.
Yes, that's a problem.
That's a problem.
And that's all administration. That's not Democrat or Republican. That's been going on for us the last 23 years.
Oh, yeah. That's what's discouraging.
Yes.
I used to say the Democrats wanted to raise taxes and spend, and the Republicans wanted to cut taxes and spend. I think of an example where things are really done wrong is California.
Mm-hmm.
So California, when the economy is going really good, they spend money. They increase the obligations of the government.
Mm-hmm.
And when things get bad, they find they have to increase taxes. And then when the things get good again, instead of reducing taxes, instead of building a reserve fund, they come up with more ways to spend money.
Yeah. Oh, yeah.
I mean, California's tax burden is so high. You have a lot of people
Leaving.
emigrating out of California.
Yes. And then California's trying to send them a bill after they leave. Hey, wait, you used to live here. Can you pay us back the taxes? They had a story from them. I lived there when I was 19 for 3 months. I was a $6 an hour security guard, and I had to get some sort of license for it. So it was about 10 years ago, I get a call from the state of California Revenue Department. They said I owed them $3,000 in tax. I said, I haven't lived there in 20-something years. And they said, well, you had a franchise. I said, it was a franchise. I was a security guard. And they wanted me to pay them I said, good luck.
Yeah, California is an example.
I think that's when Orange County went bankrupt, and they were sending their employees IOUs.
I mean, they're an example of how to do it the wrong way, and I think that's really catching up with the state. And maybe someday they'll figure it out.
Well, for years the population was growing, so they just figured demand was so great to live there because it's beautiful, right? Most of it rarely gets cold. You get the beach right there, but now they're seeing the population start to dwindle a little bit.
And that's probably going to continue for some time. I mean, we have a client that bought a place in Memphis, and there's a big push in Memphis to do software development.
Mm-hmm.
We're seeing that in Atlanta. We're seeing that in Texas. We're seeing that
Iowa, all over.
Yeah. And they're having success because the cost of living is so much less other places that you can sacrifice some of the climate for that.
Yep.
So, it's looking at the world the way it is and not the way the world was. But for investors, it's important to understand changes are happening as well. And we've seen the stocks in our client portfolios and the stock market in general climbing since October the 12th. And the chances are that's going to continue for some time. That doesn't mean it's going to go on forever. We will see some downtimes. We'll see corrections. We'll see recessions. And hopefully we won't see more than a recession. But it means understanding the way the world is, not the way the world was.
No, so let's do talking about his newsletter.
Let's do that. That's coming up. We're about to come to commercial break. So as soon as we come back from the commercial break, we're going to talk about Warren Buffett and what he had to say about what's going on.
Let's go over some of his returns too and show you that he's had some tough years.
Some tough years. Everybody that's done really well has had tough years. If you missed this program, you can find us on YouTube, About Money. You can also find the podcast on our website, so check us out. We like to show you how we do.
So, Mike, looking over Warren's track record, him and Charlie's had some fantastic years. They've had a couple duds. In 1965 when they started, they did 49% against S&P 500's 10%. And then it was a negative year for both of them the year before. They still managed to beat the market. And then in 68, they did 77% against the market's 11%. But then some years, if I keep going down, they had a great year. 79, they did 102 against 18%.
Yeah.
But down in 1990, the S&P was negative 3.1. They were negative 23.1.
In 74, they were down 49%, 48.
In 74,
Yeah.
and they were down 40. Yeah, against the S&P's 26%.
And the following year, they were up 2.5%, and the market was up 37.
Yep. And in 1999, the S&P was up 21%. They were down 19.9%. That's about a 40% swing.
99 was a funny year because 98 and 99 was the beginning of the dot-com. The dot-coms were going crazy.
Yeah, yeah.
I mean, my clients were up 4% in 99. But in 2000, Buffett was up 26%. My clients were up 38%. We had a lot of similarities between that time because both of us were avoiding the dot-coms in 98, 99.
But the S&P was down 9.9 that year in 2000. He was up 26. The S&P dropped 11. 3 years in a row, the S&P dropped.
Yeah.
And he was up in 2 of those years. He missed it in 2002, but he was only down 3.8 where they were down 22%.
Yeah, my clients were down 22% in 2002. We had great years in 2000, 2001 when everybody was getting crushed.
Yeah.
And when the market was kind of flat, we gave up some of the gains.
But in 2003, he was up 15, which is still a great return against 28. And then he didn't beat the S&P in 2003, 2004, 2005. He beat it in 6. And then in 2008, he was down 31 against 37 for the S&P.
And remember at that time, people were saying those 3 years in which he trailed.
Yeah.
2003, 4, and 5. People were saying he's lost his touch.
He's
done.
Yeah, he's done. Yeah.
You know, he's trailed the market. All those good years, it just isn't working for him anymore.
And then in 2009, he was 2.7 against the 26, so he missed it there. He beat it again in the year later. He didn't beat it against 2011. But if you go over the long haul, Mike, the S&P's up 24,000%. He's up 3,787,464. That's pretty good.
That's only a 10% difference.
Yeah, but it makes a compounded
every year.
Compounded when you compound that difference.
From 9.9 for the Standard & Poor's with dividends reinvested versus 19.8.
It's a huge number.
It's a huge number.
It's like that old story where you take the penny and double it every day for a month and ends up with some ridiculous amount of money.
$10 million.
Yeah, yeah.
So, I mean, 10% per year doesn't sound like much, but look at that difference. 3.7 million versus 24,000.
And he's done, you're reading his letter here. If you haven't read it, you can find it online. It's a fantastic letter just to read. I mean, just their patience with holding. Charlie Munger talks about the stock market as most people going out there and just trying to gamble.
Yeah.
It's a casino for them. And if you treat it like a casino, it'll treat you like the casinos treat most people, right?
Yeah.
The casinos Vegas isn't there because most people walk away with money. And so their patience in buying stocks and holding, and they've made some mistakes over time. Nobody's going to go through this without getting a little blood on their hands.
Oh, I like what he says.
It's fantastic.
Over the years, I've made many mistakes. Consequently, our extensive collection of businesses currently consists of a few enterprises that have truly extraordinary economics,
Yep.
many that enjoy very good economic characteristics, and a large group that are marginal. And along the way, other businesses in which I have invested have died, their products unwanted by the public.
Yeah.
Capitalism has two sides. The system creates an ever-growing pile of losers who are currently delivering a gusher of improved goods and services.
Yeah, I love his next paragraph, right? Our advantage of our publicly traded segment, episodically, it becomes easy to buy a piece of a wonderful business at a wonderful price. It's crucial to understand that stocks often trade at truly foolish prices, both high and low. Efficient markets exist only in textbooks. In the truth, marketable stocks and bonds are baffling. Their behavior usually understandable only in retrospect.
That's true.
It is. It's completely true. But it's, when I read this the other day and I sent it to you, I just thought this is a lot of what we think and how we process. And it's like we're looking for truly buying good, solid businesses, trying to get the best price we can, trying not to chase these things because that's when you really do get hurt. But and then holding them for long periods and waiting through that. We know they're going to fluctuate. We know we're going to have, times like when Buffett had in 2003, 4, and 5 where we might be down.
And that's going to happen.
And if you're expecting it to be up every year, good luck. I'd like.
No, there is one guy that did that.
Yeah, one guy.
Madoff.
We know how that turned out. The only other guy that did it successfully was Jim Simmons with the Renaissance technology, but he's a different story, different breed.
So when you look at what Buffett has done, you have to learn from the very best. Whether it's investing, whether it's painters, whether it's musicians, there's always something to learn.
Yeah, it's like his buddy Charlie there says, read the past, read history, read about great people, read about failures because you learn a lot from people who've done on things. Reading about Bernie Madoff and what he did wrong, and you learn from people like, even if they're horrible people, you still learn something.
And you learn, from people like that, you learn how you're getting conned.
And we see it now with the crypto, right? We see all these frauds with crypto, Bankman-Fried, things that are just too good to be true. And I don't really understand that market, so we stay away from it. Yeah. So, but I think there's going to be a lot more of that. We're going to see a lot more of that coming.
There is. And, the one thing we do post our results. But clients have a way to check on that because they can check their own account and how it's performed.
Exactly. And we post our accounts to mention this, just like Buffett did here, against the total return of the S&P 500, dividends included.
Yeah.
Not against some other. We don't switch the benchmark because we had a bad year. We're going to switch it to the MCIS or some other. There's how many thousands of benchmarks out there we could move to. We don't do that. We don't cherry pick. We don't back test.
We put up our actual result.
Yeah.
I think one sentence that Buffett had to say really applies to investors today. Don't bail away in a sinking boat if you can swim to one that's seaworthy.
Yes. That's a great line.
So I think, for me, that means if you're an investor and you've been in an account which is doing 5% a year, which is what the large majority of financial advisors are doing, if you're getting 5%, it's time to quit bailing water and jump to somebody.
Yeah. It's like he says here, the people who are so fickle. I love this line. The weeds wither away in significance as flowers bloom. It takes time. It takes just a few winners to work wonders. We don't need all our positions to do it. We know that they're not going to do well.
Yeah. Anyway, that brings us to an end for this day. We'll be back to talk more about money. And if you really want to swim to a seaworthy ship, you should give Al a call. Or me. Find us at Adams Financial Concepts.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.